Well, now I've got noon, so we can get things rolling. Thanks everybody for joining us today. Excited to come talk to our weekly market update. With that, we're going to get right into it, right? If you haven't seen it, we did do a video on tax documents. I know that's the team did that just a few weeks ago. That's probably the number one question we get, not related to the markets right now, is where are my tax docs? What days are they coming out? Be sure to check that out. If you have other questions, send them to service@o'harewealth.com. Or you can text us 414-644-0060. With that, should we get right into it, Dad?
Yeah, let's get going.
All right. What do tariffs mean to your market outlook? Are you taking this? Am I taking this one? I think I'm taking this one.
You're taking that one, yeah.
So I put this in our weekly notes. Tariffs, tariffs are fundamentally they're a tax, right? They're a tax on imports, and they're used for revenue, uh, reciprocity, and retaliation. And I put that in our notes this week, and I guess I wanted to expand on it a little bit. When I say revenue, part of the idea is to raise money. And, if you remember the Laffer curve years ago, if the tariff's relatively low, it doesn't really affect the inflow. If you make tariffs really, really high, you can actually cut off the flow of new things, right? If you had a dollar item and you put $100 tariff on it, probably not going to get many imports of that item anymore. But reciprocity is the idea that you agree, and that's like what trade agreements are about. Is the idea that I'm not going to put tariffs on you if you don't put tariffs on me, or vice versa, right? Which we're seeing with China. I'm going to put tariffs on you. You're going to put tariffs on me. We saw it earlier this week with Canada and Mexico proposing counter tariffs to some of the ones that the president proposed. That's the reciprocity, right? It's eye for an eye, or it's you treat me great, I'll treat you great. And the last one is retaliation. So that's really a fancy word for protection. Sometimes people say, "Hey, we need tariffs on the import of X good," and the classic one was always steel. We needed tariffs on steel so that our steel industry in the United States would continue to operate and be strong because foreign goods wouldn't come into dumping inside the United States. In all cases, Milton Friedman said it best years ago with tariffs. If another foreign government is willing to take money from its people in the form of taxation, subsidize a product and sell it to the American people cheaper than it should be, we really shouldn't be that upset about it. And yeah, tariffs for the most part, they can only accomplish one or maybe at most two of those goals at the same time. If you're trying to raise revenue, right, it's not really retaliatory. If it's retaliatory, probably isn't going to bring in a whole lot of revenue. If it's about reciprocity, for one way or the other, it's not about revenue anymore. So what goals you're trying to accomplish kind of matter in this case. For the current administration, I don't know if that's as clear as they'd like it to be. That's certainly not perfectly clear to us. It does raise uncertainty in the market. It's not good when you don't know what tariff policy is going to be going forward. It's tough to operate a business in that sort of environment. So you want to see a consistent rollout and a consistent messaging and a sort of finite messaging as to what they're going to be. So that's what we're looking for and hoping for from a market standpoint. And so far, we haven't quite got that. Now, in both cases, we ended two trade wars in basically a day. And part of the reason is because we are the single largest buyer of most of other people's goods. Canada, 35% of their economy, I believe, is tied to exporting things to the United States. For Mexico, it's I think 25 or 35%. It's in both cases, it's huge. China, I think it's like 8%. It's much, much lower. And we are net buyers of people's goods. We're not dependent on exports, but many countries are. I mean, Germany, a huge part of their economy is exporting goods. Many countries are dependent on exports. The United States is an importer. So for us, yeah, trade war, it lasts longer when there's smaller numbers at stake. When the numbers are this big, the problems kind of have to get resolved quickly. So for us, what do tariffs mean to our market outlook? Under the highest circumstances, and we've talked about this in the past, tariffs are a one-time inflation increase. They are inflationary. They're a one-time inflation increase. They are borne by the consumer. But even the sort of the boldest numbers we can find related to these tariffs are a 1% one-time increase to inflation, to the core PCE number. That's the highest number we can find with the potential of all a tariff policy being put in place. We've lived through higher inflation recently, and I'm not saying that it's good to have higher inflation, but that's it. 1% is probably not that much. Most likely, the tariffs have like a 0.2 to 0.3% shift to inflation. And as I think we've stated before, an increase in the oil price, up to $100 a barrel will have a far greater impact in the Americans' pocketbooks and inflation than sort of kind of the tariff policy as it's been roughly outlined. It seems to change pretty often, so it's tough to tell you exactly what it's going to be. But it doesn't shake our market outlook. We've had tariffs on China since 2017. They didn't kick off inflation in 2017, and they didn't stop inflation from going down because the Biden administration kept them. So we've had them for, going on 8 years now. They didn't kick off inflation, and they also didn't stop inflation from coming down. We don't expect them to be a massive new inflation boost.
And they didn't slow our growth either.
Yeah, and they didn't slow our growth. They were a relative non-issue. So yes, we're never a big fan of tariffs. I think Milton Friedman said it best. That they're really not great policy. But in this case, yeah, what you really want more than anything is clarity. And we do have some tariffs, and we do have some issues with the current tariffs. They don't treat every company the same, and there are definitely manufacturers that have an advantage under certain tariff policy right now. So the biggest thing is you want a level playing field, and that's what we'd like to see, and that's what we'd like to have outlined as to what that's going to look like. I'm not exactly sure, but it does not change our overall market outlook this year.
Yeah, if I can add in there too, is you have to realize we're talking about tariffs a lot. Tariffs have been commonly used in lots of administrations going way back. Famously, Ronald Reagan, a very big Republican conservative, put tariffs on Japanese motorcycles. He did this to save Harley Davidson, and it worked. He kept those bikes out for 4 or 5 years while Harley built up their business. Harley actually voluntarily took the tariffs off early because they thought they were competitive enough. We also did it with Silicon Valley in the early 80s. The Japanese on technology were way ahead, and we had to give our companies time to catch up. So we put tariffs on a lot of Japanese chips and things. And
those are those protectionist style tariffs where they're really trying to help U.S. industry stay afloat and keep industries that people consider vital or important to things like national security.
And I think the Silicon Valley example is very, very good because look what happened. We've become the leader in that area. But the bigger point is tariffs are a bargaining tool, and typically you're trying to make sure you're getting a fair deal. And honestly, we're such a big economy. For a lot of years, we didn't care that much because we were so big. The imports we had didn't really hurt us that much. But a lot of these countries like China, now they're the second largest economy. So they're exporting a lot more stuff. So it's just a bigger number for us and Europe. Europe is looking at the same issues. But, a lot of this will hopefully shake out soon because as JJ just said, it's hard for businesses to invest when they don't know what the costs are going to be. You're not going to build a new plant in Mexico if there's going to be a 30% tariff on the products. So they need to settle this. The quicker they settle this, the better it is for the market.
Absolutely. Speaking of the markets, let's go to our next topic here. It's not working. What is your market outlook for market returns going forward? I know that was a big topic from our from our outlook this year. Dad, you want to take this one? I'll zoom in and we'll talk about a chart we brought along.
Let's zoom in on the chart, and I hope everybody can see this well. But a couple of things, a couple of takeaways from here is, one is we've had some phenomenal returns in the last 5 years from the U.S. stock market. And if you look roughly in the middle of this page, the last 5 years, that's the purple graph or bar, you've had 15% compounded returns in U.S. stocks. Historically, U.S. stocks return between 8 and 12% compounded. So 15% is a very, very good number. Everybody in this business knows the term reversion to the mean. typically things will revert to the mean and come back, just like when we had low returns for a long time, we had better returns later. This is from KKR, which is one of our partners we deal with. This is their their presentation and their outlook for returns. So the historical returns are what they are, but the S&P, for example, they look at the next 5 years at maybe 6%, 5.9. So they're expecting lower returns from stocks. If we're expecting lower returns for stocks, should we look to diversify elsewhere? And that's really the other part of this chart, is to remind people there's lots of other areas to invest in that we don't normally talk about. We're guilty of the same thing. We're US and we're stock centric. We want to talk about stocks. As you look across this, starting from the left side going over, you've got cash, treasuries, global ag, that's bonds. Bonds have been terrible for the last 5 years. It's a negative 2% return, and that's because the Federal Reserve raised rates and crushed bonds. Well, that's over, and it's going the other way. So bonds should return, according to KKR's estimate, 4.4%. For bonds long term, that's a good return. High yield bonds could be 5%. If you do bank loans, which is the next one, you get 6%. Direct lending is also often referred to as private credit. And we use private credit for our clients. Private credit just means they're not dealing with a bank. A company like KKR does private direct lending, private credit. They raise money from investors and then lend it to businesses, mostly medium-sized businesses. But those have been good returns the last 5 years, 8%. And they think we'll still get 7% going forward. Well, that's pretty attractive, especially if the S&P will only return 6%. They think European stocks will return 7%, a little better. Japan has been a surprise. Japanese stocks have done much of nothing for 30 years, but the last 5 years has been a jump there, but they still are bullish there. But look at the last three: private infrastructure, private real estate, and private equity. Private infrastructures had almost 10% returns the last 5 years, but they're still expecting 8+. And these are where private companies take over infrastructure like water systems or sewer systems in different countries. And it's a pretty steady revenue business. It's a nice return. Private real estate, we've used this for years. That's buying, people typically think office buildings, but it's not just that. It's warehouses, it's rental housing, it's data warehousings or data centers. That actually looks pretty good for returns going forward. And then private equity had historically pretty much outperformed the S&P. The last 5 years, it hasn't. But going forward, if it does 11 or 12%, that's still very attractive. So we're reminding clients when we talk to them that we should be looking at more diversification. So next time you're in for a meeting, we're going to talk about this.
And we said this during our market outlook. It's great to repeat. You make money through concentration. You keep it through diversification. And part of this is about having that long-term allocation conversation with people. 2022, you know, between bonds being terrible and stocks being terrible, many people in a 50-50 portfolio were down high teens and possibly over 20%. That was a tough year. And that year at the end, I think every client kept asking me, what can I buy other than stocks and bonds? And then, of course, stocks went great for a couple of years. And now clients are asking about buying more stocks and getting more aggressive. We've had 2 great years. It's a great time to relook at things and make sure that we're properly diversified and having that conversation. So we're bringing this and talking about more of these things to more and more clients. So expect that during reviews and updates.
Yeah, the point here is we're looking for where things are going, not where they've been. The stock market's been good. There's certain 7 stocks have been great. We can't just keep buying those. That's right. Usually a bad strategy.
Speaking of strategy, that's our time today. I know briefly we'll talk about proximity. is the book. There's a short video on our review for it. We're very excited. I thought it was a great read. We also had a bonus book this month. I don't know how long we're going to talk about the bonus book. The Blues Brothers, just fun to read about. We talked about it a little bit last week. Nice one if you want something not quite our usual fare. But with that,
it's a great story. It's really a biography of John Belushi and Dan Aykroyd. It's a fun read for especially people in my age group.
With that, we're going to close out there. Thanks for joining us today. Remember to send in your questions, and we appreciate everybody coming along. Thanks. We'll talk to everybody soon.
Thank you.